This is True Multifamily, the show where we dive in on what really happens after closing a multifamily property. We're going to expose the role of asset manager. That's the person who has the responsibility of seeing the vision, executing the plan, and managing people, budgets, and timelines, all to deliver returns for our investors. These are the real struggles, the real victories, and the real stories of asset management.
Welcome back to another episode of True Multifamily. I am here with Mr. Yonah Weiss. Yonah, thank you for coming on the show.
It is my pleasure, Justin. Listen, if it's a day without a podcast, it's not a good day.
I'm happy to meet your quota for the day. We appreciate you coming on. And may I say, for our followers that are watching on YouTube, I love your background. It's beautiful. Love the background there. Yonah, for those of you who can't see, has a picture of our property, Diamond Ridge, as its background. So that's awesome. I appreciate the customization. I appreciate you coming on the show. Yonah Weiss, for those of you who don't know, just Google him or find him on LinkedIn or any other social network because Yonah Weiss is everywhere. But for those who live under a rock, Yonah, tell us a little bit about you and your company.
Sure. Well, I appreciate you having me on, Justin. Really, beyond the jokes, I really do enjoy spending time with friends and talking about this subject because it's something that a lot of people don't know about. I work for this company called Madison Specs. We're the largest national cost segregation company. It's something we're going to get into details today, the nitty gritty. But what it is, I help people save income tax. Like that's it. Property owners who own income producing properties, you actually get huge tax benefits by doing this weird thing called cost segregation. And we're going to clear it up, make it really simple today. I've not always done this, believe it or not. I didn't, when I was a little kid, I didn't think, hey, well, I'm going to do a cost segregation expert when I grow up.
You weren't 8 years old, planning out how to save people money? No?
No, I wish I would be able to save myself money when I was 8 years old, but
there you go.
I really didn't get involved in this whole industry at all for a long time. I was a teacher for many years, and that's really been my passion. And I guess, as you probably know, it spills over into what I do, just having to be that ability to give over these kind of complicated topics in a very simplified manner for everyone to understand. Yeah. But I got involved in real estate about 5 years ago, maybe close to 6 at this point, and did some fix and flips. Just got my doing commercial mortgages, got a broker's license, doing some residential stuff, just trying to get my feet wet. But in the past almost 4 years now, working with Madison Specs, doing the cost segregation thing. So I just love it. And as you said before, you find me on social media. It's because I found it's such an incredible medium. And I'm a big fan of Gary Vaynerchuk and his whole methodology of marketing and sales. It's just so easy to help people and to provide value and to have fun networking, so I found a lot of great people through that and a lot of great business.
Well, first off, the teacher side of you comes through because you educate all of us. We were just talking before the recording started. I remember listening to a podcast of yours like 3 or 4 years ago on Joe Fairless. And then, every day, another episode of, not only your podcast, but you're on someone else's podcast pretty much daily. So we all appreciate you spreading the good word about cost segregation and educating the rest of us because frankly, it's, at its surface seems like kind of a boring topic. But as we're going to show today, and for the listeners, we literally just got a report from Yonah Weiss from Madison Specs on yesterday. So we just got a report back for Diamond Ridge and so timely that we can talk through the structure of it. Obviously, I can't share the report with you guys, but we can talk through the structure and what it looks like and what kind of information in there. It's 83 pages. So Yonah will be reading 83 pages to us line by line, word for word, and that'll be the podcast. It'll be great.
A lot of fun.
But we'll talk through how to even read this thing because I think that anyone that's curious about cost seg, there's plenty of content out there from Yonah about that. But let's hit the top. Why do I want to do a cost segregation? First off, what is it, and why do I want to do it on my multifamily property?
Sure. And just to be straight up, this is for any type of property. Multifamily obviously has great benefit from it, but any type of investment or commercial property, just to clear that up, you can do it for single families also. You can do it for storage, for
okay, so I have heard that. I have seen people post online like, hey, can I do a cost seg on my single family? At what point does it make sense or not make sense to do that?
That's a great question. It Depends. I'd say, since what we're going to talk about is how we're going to reallocate the cost of the building, it's depreciation, we're going to get these depreciation deductions and kind of front load a certain percentage of them. So that's going to start making sense when you have enough tax deductions that you can front load to actually pay for, the cost of the study, number one, but to get that extra tax benefit over those earlier years. So maybe just to give a little more context, just to answer that question up front, I'd say over $500,000 purchase price. Doesn't matter if it's single family, multifamily, makes tons of sense. I'd say 10x value in doing it. Even smaller than that on a case-by-case basis, definitely worthwhile to look into. But yeah, let's step back a little bit. Depreciation, right? Cost segregation is just a fancy way of saying depreciation to the max, right? It's like you're taking depreciation, which is a tax deduction you get when you buy a property that allows you to literally write off an income tax write-off of the entire value of your property. Okay. It's like the government says, okay, yeah, you buy a property, guess what? You get to write it off, take an income tax deduction, but you have to do it over a long period of time. So, spread that over 27 and a half years if it's a multifamily or other single family, or 39 years if it is a commercial property. So that's what we do is something really cool, which is break down the property into different asset types, different classes, which depreciate at faster rates. And there's two main big categories, which we'll get into the details of those things, but it's really 5-year personal property and 15-year land improvements. So those two categories contain in them over a dozen different things or dozen categories really of things that can be depreciated at faster rates. Why should you do that? Because you want to pull out as much depreciation up front, much tax deductions up front as you can, so you can keep your cash flow as high as possible, keep your income tax liability as low as possible.
That makes a ton of sense. And we see this a lot. And actually, going through the raise that we just finished for Diamond Ridge, this was a big piece of our marketing and our capital raise, is that we are doing a cost segregation study in 2020, and you will see tax benefits in 2020. And so that was a big selling point for us. And Yonah even came on and recorded some video for us to explain to our potential investors about what that would look like. And so the benefit is, hey, if you invest here in 2020, you're going to get a pretty nice tax write-off. So can we talk through how that works? Like so we're identifying all the pieces on this property. You're breaking out in a 5-year and 15-year. How does that happen? And then how does that flow through to, a dollar or savings, tax savings to the investor?
It works like this. Like I said, you take the whole property, right, the purchase price, and then that's allocated into these different categories. Now, if you have 20% or so that you can take at a faster deduction rate, you can now take those huge tax deductions, and that offsets your income tax. So let's say on your property, maybe we can get into some real life details here, but if you're making, your purchase price, well, let's just take Diamond Ridge for an example, right? We had a purchase price of $18.5 million, right? We always have to allocate a certain amount to land. Land does not depreciate. Okay, so we put 15% to land, which is pretty average. I think people do different things. Some people less, some people more, but that's, $2,775,000. Okay, $2,775,000. That's land. The rest of it, we're talking about, a huge amount. What we're doing is allocating with the engineer report. And I think this is why it confuses a lot of people. Well, yeah, this is an accounting thing. Like, why can't my accountant do this? It requires an engineer to actually come to the property or virtually come to the property, view it, and then identify all these different things in there that depreciate faster, add them up, add the value of those things, and now you can take those as tax deduction at a faster rate. What that ends up doing is creates huge deductions in the earlier years, which if you are making money, and maybe we can talk about specifics, like how much money is the property actually making and how much depreciation is it going to offset, right? Because that's really where the money in the pocket, comes from.
Right. So we're able to, instead of spreading that depreciation out over 27 and a half years, which is pretty great anyway, right? We're taking the 18 and a half, we subtract out the land, and we depreciate that straight line over 27 and a half years. And we get a standard depreciation for every year. what you're saying is, no, we can actually identify the things that will that are going to depreciate faster, and we move it more forward into the schedule.
Right. So yeah, I mean, taking a $18.5 million property, and then even after you subtract for land, you're still getting about if you take that, divide that by 27.5, you're still getting about a $570,000 tax deduction right off the bat, just regular depreciation. But if this property is producing net operating income of anything above, $570,000, which I hope it is at that, then hopefully significantly more than that, then you are going to be subject to tax. So that's why we do the cost segregation, to accelerate that, to uptake more of those deductions up front. And in our example, I think we're talking about $4 million or so of bonus depreciation in the first year, which means that's going to carry over, going to not only offset whatever income you're making in the first year, but literally carry that over to future years.
Okay, so let's use some round numbers. Let's say that Diamond Ridge is going to make in profit after all expenses $100,000 a month, which is pretty close to our projected number. And let's say that, so we close on this property here in October, right? So now how does it factor in? Do I only get to, we've got 3 months, less than 3 months. So do I only get to count a third or a quarter of the depreciation for the year? Like, how does that work given the time period in the year that we closed?
Yeah, normally speaking, depreciation is prorated to the date in the year that you buy a property. Okay, it starts the day you buy the property. So if you bought it in October, that means you're really only going to be getting about 2.5 months of depreciation on normal straight line depreciation. And if you're doing accelerated depreciation as well, you're only going to be getting about 2.5 months out of 12. So about a little bit every single month, every single year. However, in that first year, it's going to be prorated. However, bonus depreciation, which is a new tax law, came into being about 2 years ago, Tax Cuts and Jobs Act, and that allows you to take all of the accelerated depreciation upfront in the first year. And I think it's what you guys are doing, what a lot of people do, which is not subject to that prorating. So even though you bought the property towards the end of the year, and even if you buy a property on December 31st, you can literally get the bonus depreciation for the entire, not just year, but all those 15 years of depreciation that you're accelerating.
Wow. Okay. So it's based on with bonus depreciation that allows us to any point in the year. And any point in the year we can buy this and we get credit for the whole year, basically. So in this instance, let's go back to these numbers. So we said we're making on average $100,000 a year. So call that $250,000 in profit for us from the time of close through the end of December, right? You just threw out some really big numbers, like millions of dollars. Can you explain that and what the heck is happening with all these millions of dollars? How does that work?
Yeah, we're front loading these tax deductions. So to be specific, you're only making in that first year, $250,000 a month, you said, right? So
250 for the period of ownership from when we closed through the end of the year. Yep. Right.
So on a full year scale, right? If you were to own that for the entire year, right, you'd be looking at, more like about $3 million in net operating income or so. Mm-hmm. Right. Or maybe
it's like 1.2. Like I'm just for the example's sake, I'm saying we're making $100,000 in profit. So it'll be like 1.2 for the whole year.
Gotcha. 1.2 million. So your normal depreciation, as I mentioned before, would only be $570,000, right? So you'd still be subject with regular depreciation. You'd still have to be paying taxes on the remaining, $700,000. With the cost segregation, we're front loading, in our example here, 25% of or I think a little more, which translates to, over $4 million of bonus depreciation, which means that you can take that in the first year. Now you only made $250,000 in the first year. So you make $250,000 and you have $4 million of depreciation deductions. What does that do? That, first of all, negates the $250,000. You paid zero income tax on that. And now you have this, $3.75 million loss. Okay. If you are a real estate professional, which I think a lot of people are, and even some of your investors are, you can use those extra losses that you get this year to offset other income from other sources. So that's huge, right? That's a big game changer. But your investors are not only getting their returns on investment tax-free this year, but they'll have a huge allocated loss according to the percentage of ownership. They're going to get that chunk of depreciation. It's going to carry forward. You don't lose it. Use it next year. So that's why people do the bonus depreciation up front, because it's going to benefit those people that can use it this year if they're real estate professionals, and those who can't will still get to benefit from it in future years.
Right. Okay. So even if I can't use all of it or some of it this year, it's going to flow through.
Right. So next year you'll make another 1.2 million, maybe a little more because it'll raise in value. You'll still pay zero taxes on that because the extra bonus depreciation will carry over. And then the year after that, in year 3, there's going to be enough depreciation left over from that bonus depreciation to totally offset that. And in year 4 as well, it looks like, because you have that straight line depreciation that you get, and the bonus depreciation is on top of that. So you still get that $570,000 or so every year. And what it's doing is creating maybe a little bit less because it's subtracting that prorated amount that you took, but essentially you're still going to get a huge amount. Probably the first 4 or 5 years pays, zero taxes.
So the investors, any dollar they're getting as part of the return, they're going to be able to offset. And the way what that looks like is, since they're a partner in the deal, they're going to get a K1 that shows what they earned from this property. But what you're saying is it's going to be negative, right? And they're going to get a big negative K1 this year that shows all these massive losses that their CPA, when they do the taxes, they can use to offset and write off any other passive income that they might have.
Right. But don't be afraid of the negative number on your tax return. It's not like you're losing money. You're actually making money. You're just not paying taxes on it. Exactly.
Okay, great. Really good overview of the concept. Can we talk in detail, obviously we can't show the report, but this report is 83 pages. So you sent it to me yesterday and I sort of breezed through it and I read it. I said, okay, I get this. And then all of a sudden there's a lot of detail in here. And, somewhere on page 16, I'm like, oh, okay, my eyes are glazing over a little bit. Can you just help me break down what is in this 83-page report? What is relevant to the GP, the general partnership, the active investors, and what's relevant to the limited partners and the passive investors?
So there's a lot in there. And the reason why there's a lot in here and why it's so detailed is because this is, the hoops you have to jump through in order to pass the IRS's test to do a cost segregation study. So they have a whole list of things, and there's a whole numbering system that needs to take place. There's a whole, reporting system. You have to come up with, all kinds of schedules, and you have to come with descriptions and justifications from research that was done. There's a lot that's going in here. There's also, you have to bring support from case history, all that stuff. But what is relevant to you as the partners is really just a couple pages, right? In the end of the day, what the whole cost segregation study is doing is producing a new depreciation schedule. And that one page is what you take to your accountant, who applies that to your taxes. And that's pretty much it. So all of the rest of it is, interesting, and it's cool to study. And if you want to get into the details and see, well, how is it broken out? How is it broken down? We can, there's a couple pages in this that are very clear and broken out. Like I would say, if you want to just check now, like page 15 is a very clear description of what we're doing with the cost segregation, like a summary of costs by asset, it's called. So we actually look at it and see, after all is said and done, after all those calculations and computations are made, which you can see later on, from page 15 and onwards. But on that one page, you see, there's asphalt, all the stuff that's 5-year property, all the appliances and building mounted floodlighting and cabinets and cable TV system, right? And carpeting and ceiling fans and closet rods and shelving and countertops and all these things. And the list goes on and on. You can see here, this is what we are calculating the value of these individual assets within the property that now depreciate on a 5-year schedule. And that's what we're identifying. That's what we're taking as tax deduction in 5 years.
Okay, great. Totally get it. So just as a summary, for those who can't see this, what you've done is you've taken this 15 million or 15.7 million in building costs, And you've said that 11 of that, 11.7 basically is that 27 and a half year property. So that doesn't change. That's going to be depreciated no matter whether we do cost seg or not. But what you've done is you pulled the rest forward. So there's 1.3 in 15-year property, and there's 2.7 in 5-year property. And now we can pull all that depreciation forward and get it done a lot faster. Is that a good summary? Awesome.
Yeah. And what's important to note also is that the building and the structural components, the 27 and a half year stuff also needs to be identified what the individual assets of that stuff is. So there's, you can go to page 24 on that, and that has a breakdown of the building. So we're looking at the foundation, we're looking at, the construction, the walls, exterior walls, interior wall, doors, et cetera. Everything is broken down at a cost per square footage, et cetera. Like everything literally in great detail to come up with how we get to those numbers.
Got it. It is
that's
super
where the
detailed.
engineering, that's where the engineering, stuff comes in.
We let the engineers do what engineers do, and they produce this information for us. Okay, so I've got my breakdown of what it cost me and what I can. Now, by the way, this is a rebuild cost, right? So if these costs are, if I were to go and build this building new, it would cost me this many dollars. Is that how that works?
There's a calculation that is done in that way because, essentially what you're doing is, since you're buying the property for 18.5 million, you're saying from a tax perspective, I have to now spend 18.5 million on all the individual components on here. So how do I reverse engineer everything, even though like it really could have taken about maybe like 5 million or something to build this property, but now I have to have a give a premium, right, to certain assets, and like I said, there's a very detailed calculation how much how that's done.
Got it. Okay, what's the next piece of information that we need to look at in this report?
Again, I would say like you go to the depreciation schedule, and that's it. So that's page 25 and 26. There's two alternative depreciation schedules. One's for the regular cost segregation, and the second one is for 100% bonus depreciation. And that we do both of those so you can decide and choose which one you want to use and which one you want to have going forward.
Got it. And that's the information that my CPA is interested in. Those 2 pages. We tell them, how do I determine whether I want to do bonus depreciation or not? Like that's something I have to tell my CPA, right?
Yeah, absolutely. And it may very well be like a lot of people just do the straight line depreciation or the regular cost segregation, and they may not want to take it as 100% bonus depreciation. So that's why we prepare both of these.
Why would you not want to do that?
It's, some people don't want to take all these losses. Maybe they don't need them. Maybe it's enough, the regular depreciation, to offset any income they have. And I think it depends a lot on, who are the owners, who are the investors involved? Are they going to benefit from it? That's usually the main reason. Got
it. Okay, great. So then I send this to my CPA, and he works his magic, and he kicks out some K1s based on the income that the property makes. Awesome. So let's talk about the question that I get a lot as I'm raising money and we're talking about cost segregation, which is what happens at the end of this, right? We've done our homework, we front loaded all this depreciation, and my tax return looks great. And in year 5 or 7 or 10, when I sell this thing, what happens then?
So at the sale of any property, you're faced with something called depreciation recapture tax. Okay, it's a tax that everyone is subject to. No matter what, when you sell a property. And there's a few different forms for that, but essentially what it means is that whatever depreciation that you've taken over the course of ownership, you now have to pay a tax on the back end. So just to be simple, keep it simple, it's usually about 25%. And so that's something that you're subject to. And everyone has to be aware of that. Yeah, you're getting these tax benefits up front. There's ways to, the time value of money that I'm now getting these huge tax deductions, able to reinvest that money, able to do whatever I want with that money from these returns. When I sell a property, I'm going to have to make sure that if I want to maximize the benefits of this, I want to make sure that I'm reinvesting in other things so that I can get the cost segregation or losses from another property to help offset that depreciation recapture tax going forward, or, do a 1031 exchange to help defer those depreciation recapture tax further. Again, there are strategies to get around that. So important to know you're subject to it, but there are ways you can deal with
There's
it
ways
as well.
around it. Okay, so a good strategy for that might be, let's say we sell sometime in Q1. We sell Diamond Ridge 10 years from now in Q1, and so in this example, you said 25% taxes. So what are they paying 25% on? So every loss, every negative K1 that they got through the years of ownership, are they paying 25% of that? How does that work exactly?
Yeah, so they're paying 25% of the depreciation that was taken. So if they took, X amount of depreciation over that course owner, the $4 million, right? That's going to be split up accordingly, right? So if they have like a 1% ownership of that, right, they would have gotten over that course of ownership about $40,000 of depreciation. So of that $40,000, now they're going to have to pay or be subject to a 25% tax on that.
Yonah, I just learned something. I did not know that. I thought that the full depreciation amount that I paid, so if I had that $40,000 of depreciation over time, I thought I had to pay that whole $40,000 back when I sold this property. You're saying no. I'm treated like that's treated like income, and that's taxed at call it 25%.
Yeah, it's a tax. It's not a recapture is a misnomer. It doesn't mean you have to pay back. The
You
IRS
just blown my
recapture.
mind, Yonah. I had no idea.
Yeah, it's a tax. So yeah, that's a very important thing. A lot of people.
Okay.
It's one of the most common questions I get. You should know.
So this is good because I'm telling people about this too, and we just did this deal. So let me make sure I get it exactly right because it's worth repeating, and I hope that all of you listening are getting this. So I pay taxes, so I'm getting a great negative K1 for being a partner in Diamond Ridge this year, right? And next year, I'm going to have all these nice negative numbers. Let's say that over the course of my ownership in this property, I've had $100,000 of depreciation that I'm able to write off, right? And so that's offset all my other income, and I'm paying like little or no taxes. It's offsetting my wife's income. This is great, right? Because I'm a real estate professional. So now in year 10, I have depreciation recapture. And what I thought was that I was going to have to pay that $100,000 back in taxes, right? Provided I don't do any of these other great ideas that you just mentioned. What you're saying is, no, I'm just taxed on the amount. I'm taxed on the amount as if it was income. So I'm going to pay somewhere around $25,000 on that.
Yeah.
Did I get that
exactly.
right?
Yeah, pretty much.
That's awesome. That's really awesome. Okay.
Pretty cool.
Very good to know. I did not know that. So great. Thank you. Now, some other strategies, right? So like you said, I still have this tax, even though it's 25% of what I wrote off, I still don't want to pay that 25%. So what then I, as an operator, want to do is I want to sell Diamond Ridge in Q1 so that I have time to find the next project sometime in Q3, 3 or 4, and I need to close on it before December 31st. And if I do a cost seg on that one, will off the negative K1 will offset the depreciation recapture on this one. Is that correct?
Yeah, potentially. But I'll make it even better than that because, this is all predicated on, the way that you're describing this, that there's just like one property exists in your whole life.
Right.
But you and I both know that most real estate investors are not just one property people.
Yep.
We're looking to buy
We're addicted.
multiple properties.
We're addicted.
Yeah, try to on this year another one, maybe next year too.
Mm-hmm.
And so you're constantly accumulating this. So concentration works best for someone like that, who is a real estate investor, someone who is actively acquiring, and so they're creating these losses that are just spilling over from all the property, because depreciation from one property can be used to offset the income from all of your properties.
Got it.
Because rental property income is treated together as one kind of group lump sum.
Got it. Amazing. So we just keep buying and we just keep not paying taxes.
Just keep buying, keep not paying taxes. Hopefully, a lot of people do the 1031 exchange. Hopefully that's not going to go away. But that's another great way to keep things moving, right? Keep the cash flowing and the taxes.
Now with what we do in syndication, it's a little harder to do a 1031. There's a lot of, but if you, absolutely. If you're talking about a smaller property or it's your own small multifamily, absolutely, look into a 1031 to save some money on taxes. And we've had some shows about 1031s as well, and it's super powerful. So if you can't do a 1031, this seems like an awesome way to go. And you just have to keep buying property and you just keep offsetting it. Yonah, this is extremely helpful. So anything that you think we should cover that I might have missed or I didn't ask you about?
There's so much we could really go. We could really go in a lot of directions with this, but I'll leave it up to you. Nothing really comes to mind specifically that we didn't touch on.
I love that we dug in on the report and we talked about it. And guys, I don't know if Madison Specs offers like a sample report that you do. Okay. So
yeah, sure,
reach out to Yonah, see a sample report, familiarize yourself with what this 83-page monster is going to look like before you get it. And they've got pictures of, my appliances in here and my flooring and top to bottom. They crawled all over this property. So it's really great. And I learned a lot actually reading through it. And I do love that you're referencing, the tax codes and this and that and precedents and lots of really good educational stuff in there. So Yonah, now's the time that you can plug yourself a little bit. Tell people what you have going on and where they can find you. Besides everywhere.
Yeah, well, everywhere. Yeah, exactly. The best place to find me, obviously, is LinkedIn. I'm very active there. In fact, I'm most responsive on LinkedIn, posting every day, a lot of content, trying to build a community there. That's best place to find me. If you want to go to my website, yonaHweiss.com, pretty easy to find out about everything else I got going on, including my podcast, Weiss Advice, which we're excited to have Justin as a guest scheduled in the coming months. So that's excited about that. I do have a really cool weekly meetup, a real estate meetup that we are totally virtual at this point, but we meet together every Wednesday at 7 p.m. Eastern. We have a different speaker on a different topic every week, which we've had, some of the biggest names in the industry. Usually get 50 to 100 people coming every week. We do the Zoom networking, the breakout rooms at the end. So you get just thrown into a little Zoom call with like 3 or 4 people you don't know. And it's a lot of fun.
That's awesome. That's great. And where can they find out about that?
You can, again, the best place to find is either my website or on LinkedIn. I'm posting about that constantly.
All right. So hit up Yonah on LinkedIn, become his friend or connection if you're not already. And check out the Weiss Advice podcast for sure, full of really great information. And Yonah, thank you so much for coming on the show. And I definitely appreciate it. And hopefully if tax codes change coming in the next few years or so, we can have you back and explain that to us and how it all impacts us as real estate investors.
Yeah, listen, if the tax code changes, I'm going to be on another 150 podcasts in the next year.
You're going to be a busy guy. There's going to be a waiting list for sure. Well, we appreciate it. Thank you so much. And we'll talk to you soon.
Thanks for listening to another episode. Check out our website at truemultifamily.show. And if you have an amazing story to tell, share it on our Facebook community, and you might just be the next guest on the show. We're also on all other social networks. Just search True Multifamily. I'm really, really proud to have the show produced by our company, On Air Brands. Check us out at onairbrands.com. We also have an incredible, unique podcasting event that we would love for you to be a part of. Check that out at podmax.co.